The buyback bonanza, a history. For much of the 20th century, stock buybacks were a relatively rare occurrence in the American corporate landscape. They were actually considered illegal market manipulation until 1982. This all changed during the Reagan era. The Securities and Exchange Commission, or SEC, relaxed its rules, opening the floodgates for corporations to start repurchasing their own shares. The stated aim was to give companies more flexibility and enhance shareholder value. The 1980s witnessed the initial surge of buybacks. This trend continued to gain momentum in the decades that followed. The logic behind buybacks is deceptively simple. By reducing the number of outstanding shares, a company can artificially inflate its earnings per share. This often leads to a bump in stock prices, rewarding executives and shareholders in the process. However, this financial maneuvering comes at a cost. The billions of dollars funneled into buybacks could be used for other, more productive purposes. These include investments in research and development, worker training, and higher wages, all of which benefit not just the company but the broader economy as well. Shifting priorities, from reinvestment to enrichment. The rise of stock buybacks has coincided with a worrying trend: the declining emphasis on long-term investment. In the past, corporations would reinvest a significant portion of their profits back into the business. This fueled innovation, created jobs, and drove economic growth. However, with the advent of buybacks, corporations have increasingly prioritized short-term gains over long-term sustainability. The focus on buybacks reflects a shift in corporate priorities from building a better future to enriching a select few in the present. Instead of investing in their workforce, upgrading equipment, or developing new products and services, many companies are choosing to channel their profits into share repurchases. This short-sighted approach may boost stock prices in the short term, but it undermines the long-term health of both the company and the economy. This shift in priorities has far-reaching consequences. When companies prioritize buybacks over investment, it stifles innovation, hampers productivity growth, and exacerbates income inequality. Workers are denied wage increases and better benefits, while CEOs and wealthy shareholders reap the rewards of inflated stock prices. The CEO incentive, stock options, and buybacks. The proliferation of stock buybacks is inextricably linked to the way CEOs are compensated. Since the 1980s, there has been a dramatic shift in executive pay, with a greater emphasis on stock options and other equity-based compensation. This means CEOs have a vested interest in boosting their company's stock price, even if it comes at the expense of long-term growth and worker well-being. Stock buybacks have become a favored tool for CEOs looking to inflate their compensation packages. By reducing the number of outstanding shares, buybacks artificially boost earnings per share, which in turn can drive up stock prices. This creates a perverse incentive structure where CEOs are rewarded for financial engineering rather than genuine business growth. This focus on short-term stock performance has created a culture of short-termism in corporate America. CEOs are under constant pressure to deliver quick returns for shareholders, even if it means sacrificing long-term investments that could benefit workers, communities, and the economy as a whole. This creates a vicious cycle where buybacks beget higher CEO pay, which in turn fuels more buybacks. A tale of two GMs, buybacks versus investment. GM's shift from innovation to stock buybacks led to its decline. Post-World War II, GM thrived on innovation and reinvestment. But in the 1980s, GM prioritized buybacks over growth. Billions were spent on buybacks, neglecting innovation. This led to a loss of competitiveness and market share. The consequences were devastating for GM and its workers. Fueling the fire tax cuts and the buyback surge. The 2017 Tax Cuts and Jobs Act, which slashed the corporate tax rate from 35% to 21%, further exacerbated the buyback frenzy. The law was sold on the premise that it would boost investment and create jobs. However, corporations used the windfall from the tax cuts to finance a record-breaking wave of stock buybacks, further enriching wealthy shareholders and executives at the expense of workers and the broader economy. Instead of using the tax savings for productive investments, as proponents of the tax cuts had promised, corporations funneled trillions of dollars into stock buybacks. This further inflated executive compensation packages and exacerbated wealth inequality, while doing little to boost wages or create jobs. The tax cuts, coupled with lax regulations on buybacks, created a perfect storm for corporate short-termism. The surge in buybacks following the tax cuts underscores the need for policy solutions to address this issue. It is clear that simply hoping corporations will act in the best interests of their workers and the broader economy is not a viable strategy. Reining in buybacks? Policy solutions for a more equitable economy. Limiting buybacks and taxing them can fund public investments. Strengthening worker representation on boards shifts priorities. Reforming executive compensation ties pay to long-term performance. Disclosing buyback impacts on wages and job security is crucial. Prioritizing long-term investment and worker well-being creates an equitable economy. The road ahead? Curbing buybacks for a sustainable future. The current trajectory of unchecked stock buybacks is unsustainable. It undermines the foundations of a healthy economy, exacerbates inequality, and erodes public trust in corporations. By understanding the historical context, the perverse incentives, and the devastating consequences of excessive buybacks, we can begin to chart a different course. Policymakers, business leaders, and citizens must work together to create an economic system that prioritizes long-term investment, shared prosperity, and a sustainable future. Reining in buybacks is not about punishing success. It is about ensuring that the fruits of economic growth are shared more equitably, and that corporations are held accountable for their impact on workers, communities, and the environment. The choice is ours. Continue down the path of short-termism and widening inequality, or embrace a more balanced and sustainable approach to economic growth that benefits everyone. By curbing the buyback bonanza, we can create an economy that works for the many, not just the few.